Bitcoin and cryptos are just part of it. What happens when that everything rally fades? That's the bottom line. Is if you're in cryptos, you've done great this year. If you're in gold, you've done okay. If you're in commodities, not so. If you're in stocks, you've done well. It's all together. It makes sense after that big flush last year. It's the next 12 months that matter. The bottom line is the Federal Reserve is still tightening. We have nowhere near the early days of that kicking in. Here's one thing. I love hearing how home builders are doing great because the housing market is seized up because people won't sell because interest rates are high. I mean, give that a year or maybe 6 months. What does history prove for these type of environments? When markets seize up, it's never been good.
The entire outstanding public debt on America's balance sheet is increasing rapidly. According to newly updated figures from the government's fiscal data platform, the country's debt has increased by $57.2 billion in 4 days. After passing the $32 trillion threshold on June 16, the United States' overall debt has already risen by $590 billion as of July 20. Mike McGlone, Bloomberg Intelligence's chief commodity strategist, took to Twitter to post a screenshot from a recent Bloomberg report that includes some significant Bitcoin information. McGlone feels that if Bitcoin does not increase above the present $30,000 level, it may be a bad indication for the entire U.S. economy. According to the expert, shoot the flagship cryptocurrency, which many see as the fastest horse in the race, halt at the $30,000 range. Despite the hype generated by the potential introduction of a Bitcoin spot ETF, it may suggest larger economic problems than the U.S. is currently experiencing. In this video, Mike discusses interest rate hikes, as well as geopolitical and macroeconomic events in Japan and Brazil. He also discusses the PPI, Fed tightening, and the liquidity pump. So like, subscribe, and sit tight while you watch.
Obviously, we're going to get 25 basis points today, and then we have every other central bank, with the exception of China and Japan, all following the Fed. And I do enjoy this narrative when people say the U.S. is less significant, it was economically, but I ask the central banks, it's more significant than ever. And they're just scrambling to keep up with the Fed. And Brazil was a little bit ahead, but the macro is, bottom line is, don't fight the Fed. And everybody does, and then beware of the general consensus, which is, oh, once the Fed stops tightening, everything's okay. But typically that happens after you get a decent, downward correction in the stock market and we don't have a recession. Now, this is not happening yet, but I look at it as what you mentioned earlier. If you look at just producer price indices, the year-over-year measure, it's down 3.1% on the year. Now, that was quite expected, but Fed's never tightened in that environment, and they are. And they're watching sticky measures, which we all get. But remember, those sticky measures were all boosted by one thing, the biggest liquidity pump in history. That's dumping. So I look at markets now as, yes, all the technicians say, okay, now the stock market's up, 70-something percent from the bottom. It has to keep going higher. I remember, to me, that watch out for consensus like that. But I think what you suggested is sometimes you just have to be prudent. Now, we have basically had 100% rally in Bitcoin from way oversold. And one thing I did have a chance to do on my vacation is I always love to catch up on financial history and reading. It's just kind of my passion, and potentially I do it for a living. And I'm kind of wanted to push back in my view that we're going to not have a reset of a lifetime, and have actually accentuated. I think we're going to have the biggest reset of a lifetime, partly because what's happening with the narrative. And the key thing is crypto. So bottom line, I'll mention in macros, every major pump in history, every major technological revolution comes with a liquidity pump, and that technology leads it. And this one has been in the back of cryptos. And that's been my theme, is if I'm right on this theme that we're all going to tilt over to a pretty severe depression, unfortunately, I just have to point out, if I see a hurricane come, I'm seeing it, it should be starting with cryptos. Now, we're seeing more of that now. Bitcoin stopped around 30, you got a little bit above it. It just can't get above it despite the stock market still inching higher. Now, key question I ask myself is, just imagine we get to normal Q4, Q3 later volatility in the stock market, with the Fed still tightening, and the tilt towards recession, which is not supposed to happen now. Just if we get a normal little pullback, what happens to these high beta, high velocity assets? And that's happening. So I'll end with this. On a 1-year basis right now to July 24th, the S&P 500 gold, and the Bloomberg Galaxy Crypto Index are all up about the same percent, 15%. The lowest volatility is gold, so that's the best performer. When you do your measures, you do your value at risk, you're running hot money, which I've done with clients, you're going to overweight that gold, and the highest volatility is the crypto, so you're going to underweight that, and it's been your worst performer. So I look at it, okay, so what's the next year going to happen? The key thing that's dropped is the TLT. That's the bond ETF, the main one. It's dropped about the same. So I'll end with this. We just had our morning meeting. Anna Wong was typically pointing out normal things about the Fed, but our interest rate strategist, Ira Jersey, says he's looking for a bull steeper. And I agree with that, particularly as I've seen we've had a collapse in commodities, a little bounce, and I think we're going to head back towards that trend. Back to you. Be careful what they say and watch what they do. They're trying to cut rates. The whole commodity market's dependent on them to add stimulus, and yeah, they might be able to cut rates. That's easy, but everything else means it has to go through Politburo. Actually, it doesn't matter. It's only what Mr. Z says. But the key things that I think Peter and Dave mentioned, I want to address on. We've had purchasing managers indices come out of Europe again, following the trend of weaker than expected. And in that same environment, we expect more hiking from the central banks in Europe. That's an oxymoron historically. In the meantime, I mentioned producer price index is collapsing at the price is the highest point in history, and the Fed is still tightening. Those are the oxymorons I think we're going to look back on, and people like us write the textbooks. I'm hoping live to right now. Yeah, that was silly, but it's just when you're in the middle of it, you don't realize it. But this is where I want to also, Dave and I agree on so much, and this is not a pushback. I agree on the big picture, macro. We get that. It's just such a known. Now I look at it, it's okay, show me the beef. And that's the big problem is, yes, we all knew Bitcoin was too darn cheap at 15,000. But at 30, this massive spike, yes, it should continue outperforming the broad macro, broad crypto market. But we still have this massive speculation in that space, and that's the problem. Show me the beef. Show me the Bitcoin. I need to see it from markets. I always like to say, let markets prove that Bitcoin's going to start outperforming gold and outperforming the stock market on a relative risk-adjusted basis, particularly if and or when we get a Fed tilt towards ease. And that's the way that our strategists are looking for that steepener, Dave. And to explain that to some of our people might not understand that means when long bond rates, when short rates drop faster than long bond rates, that's the curve re-steepens. Right now, it's the most inverted in 40 years. So those rules are still prevail. And I look at it as this is the silly stage. I view this as that we've all been through silly stages and they can last for years. Typically it's months. And I see this as a silly stage in terms of the equity market. Yes, I'm very bearish in the equity market, but it's also, I sense the similar bullishness in the equity market that I sensed in Bitcoin when it was at 31,000 just a month or two ago. And everybody said I was an idiot for you got that. I mean, oh, don't you want to be rich? I remember hearing those quotes. It's just those little tweaks you get sometimes from people who you realize like, yeah, I probably want to do the opposite you're doing. You always have to be on the lookout for potential catalysts or triggers. And I think based on the last few things we all said here is that I always go back to this quote from Benjamin Disraeli, former UK Prime Minister. What we anticipate seldom occurs. What we least expect generally happens. Now that's really the case in markets, and it was clearly the case in commodities last year. I mean, I was the idiot who said, no, they always go back down if they go up. That was just not profound. And to me, it's also what Peter said about the pendulum. It's the pendulum always swings in markets. It's a question of how far and when. And to me, that is the key thing is everything has swung up this year. So one word is, we all don't like the word bubbles. I'm also very fearful of the word crash. I'm not calling for a crash in equities. I'm just looking for, pointing out the typical underperformance period after a typical outperformance period on the back of liquidity. It's always the way cycles work. It's just a question of when and catalysts. And I think one key kind of catalyst, you always can't predict them, but you can try to figure out what might happen. I'm worried about what's happening. Well, we should all be worried about what's happening in Russia, what they did lately with bombing some of the grain exports is something potentially going nuclear. Now, that's not Russia again. It's one person who's backed into a corner. So don't want to trade for that, but it's something. And it's also, what is the market stance if you get a catalyst? Now, if the stock market's relatively cheap and bond markets are relatively cheap and you get a catalyst to make them go cheaper, they usually don't move a lot. But if they're relatively expensive on a specific hopium that markets will go up because they went up, which is where I think we are right now, one little catalyst is what it takes. Remember, we all remember 9/11. It came as we started tilting lower, and it just accelerated that bear market. Now, that was very unusual. So, but here we do have a hot war in Europe. We have major negative, people had the bounce in economic growth in Europe, and now it's all tilting back lower, and they're still tightening. And then we have crypto in the middle, and crypto is basically underperforming risk-adjusted basis this year. So what does it happen next year? Maybe Bitcoin starts trading more like gold. I'm more biased towards gold and long bonds, to be honest with you, if this continues to work out with the Fed tightening into a deflationary environment.
What do you think the next Bitcoin price will be, and how will it affect the market? Please tell us in the comments section below. Also, remember to like, subscribe, and enable notifications.